on refiners, MRPL as well as CPCL. I'll tell you why. Because refining capacity globally, well, it's in a bit of a short supply, which could probably throw up a refining opportunity just in the near term, in the next 2 quarters or so. And hence, the core refiners will be in focus, which I mentioned as MRPL and CPCL. But before we explain the thesis to you and what's going on, let's explain to you the risk first. It's a sunset sector. So re-rating may not happen, and GRMs, they're very volatile. So earnings projections as well are rather tricky. That said, MRPL results were weak, but that was because of 2 factors. Shutdown, which impacted the refinery throughput, which came down by close to 24%. And inventory losses as well, which were reported. That's what led to GRMs declining. The question is, can Chennai Petro do relatively better? Let's state a few reasons out. Because there's no major shutdown, right, for CPCL in Q1 FY26. So on the volume parameter, it'll do relative outperformance. Secondly, the GRMs, well, they'll be hit by inventory losses, like it was the case with MRPL. But there was no shutdown, which will cushion the hit as CPCL has been focusing on the reduction in fuel and loss, which has come down from around 10.7% to around 8.5%. Now, analysts estimate that that could be a few hundred crores that's been getting added on an annual basis. That's on the profit before tax parameter. So the operational efficiency is something that they've been looking at. Next up, the share of diesel in the refining mix for CPCL, it's at more than 50%. Remember, diesel cracks, well, they're higher than petrol cracks. So in that parameter as well, they're relatively cushioned. And on the valuation parameter, if you look at it, CPCL is trading at a discount to MRPL. And on the replacement cost basis as well, it's trading at a bit of a discount. So valuations give some comfort. And the other factors we need to track from here, if it's actually going to be so good for them, then the dividend payout will be important. Last couple of years, they've paid out close to 30-35% of in FY24 as well as FY25. And interest costs have come down sharply. Last year on an annual basis, it was around 245 crores. A few years ago, it was more than 410 crores. So sharp reduction in net debt as well we have seen. So I'll keep an eye out on both these two in case things are going to be so good. Debt reduction as well as dividend payout. So there is always a risk with regard to refiners because the GRMs are very, very volatile. But in the near term, the next couple of quarters, particularly Q2, could look up for both these two names. For the time being, MRPL's numbers are disappointing, but the street seems to have bought into the dip on CPCL. Sudeep, it's a tricky subject, GRMs. What's